To put it simply, these were bets that silver prices would fall. The trader wasn't just betting against long positions in silver futures. He was using complex strategies like put options, bets that allow you to profit if the price drops. These moves created a huge imbalance, and because they were so large, the central authorities, including the PBOC, had to step in to prevent total market chaos. Think of it as a fire that almost spread across the global silver market, but was stopped just in time. The stakes are enormous because these short positions were largely unhedged, meaning there wasn't enough actual silver backing the trades. This could have created a situation where physical silver delivery would be impossible, potentially causing a too-big-to-fail scenario in the futures market. That's exactly why both the CFTC in the US and the CSRC in China are now monitoring the situation closely, ensuring that positions are unwound in a controlled, orderly way. Meanwhile, despite these regulatory interventions, short covering has already started. Some traders are buying back silver to close their short positions, which could create temporary upward price pressure. But here's the key. The real driver behind all this isn't speculation. It's the transition of silver from a speculative paper asset into a high-quality physical asset. In simple terms, the Chinese government is slowly turning silver into a globally recognized monetary asset, much like gold. The implications are huge. Physical silver is scarce, and the current market shows clear backwardation, where the price of silver today is higher than future contracts. This happens when there's strong demand for immediate delivery. Even after the recent sell-offs, lease costs for borrowing silver remain extremely high, signaling that physical shortages have not been resolved. What does this mean for investors? Paper trading on U.S. exchanges like COMEX is increasingly unreliable. The Shanghai Gold Exchange, SGE, where silver is fully backed by physical bullion, is becoming the global hub for real silver trading. China's Golden Yuan initiative is integrating silver into its monetary system, ensuring that it's no longer just a speculative industrial metal, but a high-quality liquid asset that can act as money. So, if you're following silver and gold markets closely, this is a turning point. What used to be a game dominated by derivatives and paper contracts is shifting toward real physical assets, and the rules of the game are changing fast. Stay tuned on Gold Silver Scope, because in the next parts, we'll explore how this shift affects gold, silver prices, and what it means for investors like you heading into 2026. Now that we understand how massive short positions triggered regulatory action, let's talk about the next big event, the potential silver short squeeze. On Gold Silver Scope, we aim to explain this in a simple way so you can see what's happening before the markets fully react. A short squeeze happens when traders who bet against silver, short sellers, are forced to buy back their positions because the price is rising or because regulators are controlling the situation. The Chinese authorities, especially the PBOC, are carefully managing this process. They can't just force the shorts to cover too quickly, because that would cause chaos in both physical and paper markets. Instead, they're unwinding the positions gradually and strategically. Why is this such a big deal? These shorts are not backed by actual silver. This means that if everyone tried to get the physical metal at once, there simply isn't enough silver available. Reports indicate that global exchange stocks of silver are already dwindling, and the lease rates to borrow silver are extremely high. Even after recent market corrections, the cost to borrow silver remains at record levels. This proves that physical silver is scarce, and demand is outpacing supply. At the same time, the Shanghai Gold Exchange, SGE, is emerging as the primary place where physical silver is traded and fully backed. Unlike COMEX, where paper contracts dominate, the SGE ensures that each silver contract represents real, deliverable metal. This shift is crucial because it provides a reliable benchmark for silver prices, giving investors confidence that their holdings are backed by physical metal rather than just paper promises. China is also positioning silver alongside gold in its Golden Yuan framework. This essentially turns silver into a high-quality liquid asset, HQLA, similar to gold. In practical terms, it means silver can act as a form of money, just like gold, but with broader applications for everyday use and institutional finance. Over time, this could allow silver to reclaim its role in global monetary systems, not just as an industrial commodity, but as a trusted financial asset. So, what's happening on the investor level? Many Western traders relying on derivatives, ETFs, or paper contracts are now at risk. The shorts are being squeezed, and the physical silver market is gaining dominance. For those holding real bullion or SGE-linked products, this is a huge advantage. These investors are positioned to benefit from rising premiums on physical silver as the market continues to absorb paper shorts. Another factor driving this market shift is the massive backwardation in silver prices. Essentially, the price for immediate delivery is much higher than future contracts. This happens when demand for real silver exceeds supply. Backwardation also signals that traders want physical metal now, not later, highlighting the growing gap between paper and real markets. Meanwhile, the PBOC is quietly building a massive silver stockpile, alongside gold. This gives China the ability to convert SGE-backed silver into a globally recognized high-quality asset. For investors, this is a signal that silver isn't just being hoarded. It's being prepared for institutional and monetary use. The implications are profound. Silver could soon operate as a currency-like asset in the global financial system, backed by real physical metal and insulated from derivative market chaos. It's also worth noting that this move reduces reliance on Western exchanges like COMEX, which have been increasingly dominated by speculative, paper-driven trades. The extreme bid-ask spreads, sometimes as high as $5 per ounce intraday, show how volatile the paper market has become. By contrast, the SGE ensures fairer pricing and actual delivery, which is why it's becoming the new global benchmark for silver. For investors looking at 2026, the takeaway is clear. Physical silver is becoming the real play. The paper-dominated markets are losing credibility, and the emerging Asian markets are establishing dominance with fully backed contracts and strategic stockpiles. If you hold only paper silver or ETFs, you're exposed to these systemic risks. But those who position themselves in physical silver or SGE-linked products are gaining a first-mover advantage as global markets pivot. In the next part, we'll break down what this all means for gold and silver pricing, including the potential gold-to-silver ratio, upcoming market catalysts, and what investors should watch closely to time their positions correctly. Stay tuned and make sure you're following Gold-Silver Scope for the full breakdown. We've covered the massive silver short squeeze and the rise of physical-backed markets. Now, let's zoom out and see what this means for gold, silver, and investors heading into 2026. On Gold-Silver Scope, our mission is to make sense of these complex markets so you can act with confidence. First, let's talk numbers. Analysts are projecting that the gold-to-silver ratio could move back to historic levels around 15-1. To put that in perspective, with gold currently estimated around $8,000 per ounce, silver could approach $500 per ounce, far above its current inflation-adjusted $230. This isn't just speculation. It's driven by China's Golden Yuan framework and the growing physical silver stockpiles. When silver is treated as a high-quality liquid asset, its value moves closer to gold, establishing a much higher floor than we've seen in years. The implications are huge for investors. Paper-driven markets, such as ETFs or derivative-heavy platforms, are becoming increasingly risky. The COMEX market, once considered a reliable benchmark, now shows massive volatility and unrealistic bid-ask spreads. Meanwhile, The SGE ensures that silver contracts are backed by real metal, giving investors peace of mind and liquidity. This is not a small change. It's a paradigm shift from paper speculation to physical, tangible assets. Gold, of course, remains a cornerstone. But the exciting shift is that silver is now being monetized in a way it hasn't been for decades. Just like China opened gold for the public over the last decade, silver is being incorporated into the national monetary system. Over time, this could allow billions of people to use silver as money, establishing it as a reliable store of value and a hedge against inflation. For investors, this means strategy is key. Physical silver, SGE-backed products, and allocated bullion are likely to outperform paper silver or short-heavy positions. Holding these assets now could capture both upside from global premiums and protection against derivative market shocks. The era of cheap silver and underpriced gold may soon be over, and positioning wisely today can make a significant difference. Global geopolitical uncertainty, currency debasement, and increased demand for physical high-quality assets are accelerating this process. By 2026, the world may see silver and gold reclaiming their monetary prominence, backed by real metal and integrated into new global financial corridors. China's stockpiles, along with vault expansions in Shanghai, Shenzhen, Hong Kong, and upcoming hubs in Singapore, Africa, and the Middle East, are laying the foundation for this transformation. In short, the markets are signaling a new era. Silver is no longer just a commodity. It's becoming a globally recognized, physically backed monetary asset. Gold and silver are now positioned to operate as high-quality collateral in cross-border finance, providing a safe, liquid alternative to riskier assets like treasuries or derivative-heavy funds. So what should you do as an investor? Keep a close eye on physical-backed silver and gold. Avoid overexposure to paper contracts or short-heavy ETFs. Watch the gold-silver ratio, monitor backwardation, and consider SGE-linked products if you want to be part of this transition. The window to position for the coming silver squeeze and gold's next phase is now. If you want to stay ahead of these major moves and understand how to navigate the changing landscape of gold and silver, make sure to subscribe to Gold Silver Scope. We bring analysis, updates, and actionable insights directly from the markets to you. Disclaimer: this content is for informational purposes only and does not constitute financial advice. Investing in precious metals involves risk, and you should consult your own financial advisor before making any investment decisions.